Thanks everyone for joining, and welcome to our first workshop here for real estate acquisitions. We have a great case in store, which will be covered by Alex O'Connor. Hopefully everyone can see me and hear me okay. Just want to open with a couple quick words about Alpha Fellowship, and then share a brief agenda of what we're covering this evening. And then we'll get right into it. So first, about Alpha Fellowship. So we're an accelerated applied learning company that essentially builds and delivers courses with industry experts. So in all of our course topics, we're developing these courses in partnership with industry experts and creating a live learning experience delivered by those folks, and then coupling that with real world applied project work. If you want to learn more about that, feel free to visit our website. We'll have the link up at the end of the talk here, but just a brief word about Alpha Fellowship. This is the 195 Broadway case study, which is essentially a view of our real estate acquisitions course that Alex O'Connor teaches. We'll cover that case study, and then after that, we'll cover several tips for pursuing commercial real estate, either brokerage or finance. So for folks looking to get into that field, or perhaps looking to make a switch into acquisitions or finance, some focused tips there. And we'll have Q&A at the end. So with this case, just to kind of prepare you for the takeaways you'll be hopefully learning, it's really touching on the complexities of private equity real estate transactions. This one being a really iconic example. You'll learn about the roles played by GPs and LPs, the GP and LPs, and Alex will get into that, and how these deals are distinct from other private equity deals, some of their nuances. And then at the end, some core skills that you can use to differentiate yourself within CRE, again, whether you're pursuing brokerage or acquisitions. One quick admin item: if you have any questions during the talk, just submit them via chat and we'll cover them at the end. And we can jump in. So we'll start with the survey here. We just want to have a chance to learn a little bit about the folks on the call. Should just take maybe a minute. So that should pop up now. Go ahead and fill that out, and we'll jump right back in. All right, I think we've got responses in from everyone. Go ahead and share these. So it looks like primarily folks working in real estate. That's great. I know we have a number of folks coming here from brokerage, some from private equity. So thanks for being here. It's great to have you. Just looking down here. Get a lot of interest in the case study, which makes sense. Okay, so a lot of interest in the core technical skills. That's sort of the standout item, which is great. We'll touch on some of those certainly in here, and then areas to focus on. Great. All right, super. Well, thanks to everyone for spending a minute on the survey there. It helps us know sort of what it is you're looking for and who's on the call. So I think with that, we'll hand over the mic here to Alex and jump into the case.
Yeah, sure. Appreciate it, Matt. Let me pull up the presentation here. Can you enable screen sharing for the attendees so I can put this up?
Yep, doing that now. Should be good now. Try again, Alex.
Okay. Let's see. All right, that full screen for everybody?
Yeah, looks good.
Okay, cool. You know what? My dog has a squeaky toy. Let me just go grab it from her 1 second. I'll be right back.
It's a bonus.
Yeah. All right, sorry about that. Yeah, so today I'm going to go through a transaction that I worked on last year. We closed this deal in November 2019. And the asset is 195 Broadway, which is an office building located in downtown Manhattan. So it's a 29-story building, 1.1 million square feet. It was originally constructed as the headquarters for AT&T back in 1912. And they occupied it as their headquarters until 1984 when they moved uptown to 550 Madison. Since then, it's been occupied as a multi-tenant office building, and it is a landmarked property, meaning that you have pretty severe restrictions about what kind of modifications you can make to the outside of the building, as well as to the lobby on the ground floor. So these are just some photos of the asset. It's got a really spectacular lobby with these, 36-foot high Doric columns, Greek-inspired architecture. During L&L's ownership period, we went through a very comprehensive retail and lobby renovation program. So we spent 10 years working with the Landmarks Preservation Commission in order to be able to convert this huge lobby into 25,000 square feet of retail, separated by 36-foot high panes of glass to kind of preserve all the original details without obscuring the original character. So these photos here are of Nobu, the sushi restaurant, which is one of the tenants that we put in a few years ago. So L&L's history with the asset, we've actually owned this building 4 different times with 4 different partners. So our original acquisition of the property was in 2005. We bought it for $265 million with GE Pension Trust. 2011, after the financial crisis, we recapped it with Beacon Capital Partners, thankfully still above GE's basis there at $280 million. A few years later, as the market continued to recover, we recapped it for $500 million with JP Morgan. And then most recently in 2019, last year, for $800 million with Samsung, based out of South Korea. So something that might not be obvious to people who are kind of outside the industry or new to the industry is that in commercial real estate, you typically capitalize a deal with a general partner, often known as the operating partner, and a limited partner, sometimes known as the money partner. So the firm that I work for, L&L, we own and manage 10 million square feet in New York City, and we're a general partner or an operating partner. So in most of the transactions that we do, we only put in, generally 2 to 5% of the equity for any given transaction, and we bring in an outside institutional investor who puts in the vast majority, 95 to 98% of the equity into each deal. And that's a pretty common structure in the commercial real estate world. And as general partner, we have day-to-day control over most decisions. We set the overall strategy, handle the leasing, the property management, et cetera. But there are decisions that the limited partner has rights over, typically sale and financing. Kind of makes sense given the fact they're putting in the vast majority of the money. And there are a few ways that these limited partners can achieve liquidity, in other words, be able to sell their position. Some of the common mechanisms would be right of first offer, right of first refusal, a buy-sell mechanism, a forced sale. So these are all different kinds of liquidity mechanisms that we would talk about in the course. Each one has advantages and disadvantages to both the LP and the GP. And there's a lot of nuances about how you go about exercising these liquidity options, a lot of considerations about what price to set for these various options. There's considerations about not wanting to go in too high or too low for various reasons, depending about which side of the transaction you're on. And all those kind of nuances are things we would discuss in the class. But in the case of 195 Broadway, the price that we had to hit for this most recent recap was $750 million, plus about $50 million in outstanding capital commitments. So that brought our effective price up to $800 million. And that's the price that our partners set. And if we wanted to effectively buy the building from them with a new partner, be able to stay in the deal, continue managing the property, continue earning fees from the property, we had to hit the bogey of $800 million. This price worked out to about $750 per square foot, which is, quite high for downtown Manhattan. There's not a lot of, sales comps you can point to other properties that traded at that level in that immediate area. And the cap rate, which is a return metric that's unique to real estate, was about 4.75%, which was also pretty low for a building, of this vintage in this submarket. So it was definitely a tall order. The price that they offered it to us at was, a steep price that was going to exclude a lot of investors. So we knew we were in for a tough capital raising process. But thankfully, we've learned over the years, we've been very successful in doing these recaps where our partners need liquidity for one reason or another. We've been very successful in kind of rebuying these properties over and over again with new partners. And there's a lot of buildings in our portfolio where we've done that 2, 3, 4, 5 times at this point. And the reason they need to sell can vary. Your partner might be a private equity fund that's closed end. So at some point, they're going to have to return money to investors. So they may need to sell for that reason. It may be a pension fund who just has an allocation change where maybe they're overweighted to real estate, so they need to trim their portfolio. For whatever reason, your partners eventually need to exit, and you got to give them the ability to do that. So the thesis for this recap last year, at that stage, the building was 100% leased on the office side. There was a little bit of retail vacant, but it was 100% leased with a 12-year average remaining lease term. So it's what we would call a core transaction, right? Fairly low risk. It's well leased to credit tenants, including companies like McKinsey, HarperCollins, Gucci, Omnicom. High credit, fully leased, long lease terms. All of that translates into low risk and therefore low returns. And the property also is in exceptional physical condition. During our ownership period, we had poured in close to $80 million in capital improvements, cosmetic improvements plus base building improvements. So the next buyer coming in today, really doesn't have to put in a lot of money over the near term. And so the pitch is really going to be to more institutional investors, such as pension funds, insurance companies, and maybe core plus funds from various private equity firms. So we went out to 95 equity investors, cast a pretty wide net. We talked to all sorts of firms, pension funds, sovereign wealth funds, core private equity funds, high net worth individuals, insurance companies. And, as expected, given the very high price, it was a challenge. We got a lot of no's. And the most common feedback we got, number one, was just the check size. At an $800 million purchase price with conventional mortgage financing of somewhere in the range of 50 to 65%, it would have been an equity check of between 280 and 400 million. So that's a big check. Even for big institutions, it's a lot of money to allocate to one deal. People were concerned about the basis. I mentioned before that there wasn't many, other sales in the area to point to that were hit that $750 per square foot mark. And also, it was challenging because, foreign investors typically need a 49% partner who's based in the United States, for tax reasons. And, given the high check size for a domestic firm, there's not a lot of people that can write that kind of check. So we had to craft a really compelling story to get people over all these hurdles and convince them that, the deal was worth doing. So one thing that we kind of noticed as we went through this process was, although it was a core deal, so, low risk, low reward, the total return was fairly low. You're going to have an IRR in the 8 to 10% range for a core deal, typically, total return. The current yield was pretty high. So in real estate, that's a metric we call the cash on cash yield. And so we identified that certain kinds of investors, particularly Korean investors, are especially drawn to high current yields. And most institutional investors have leverage limits where they're only able to put on typically up to 65% financing via a mortgage. That's just kind of their institutional limit. But there is this kind of unusual structure called a fee bifurcation that you can employ to kind of boost your look-through leverage. So when I say a fee bifurcation, typically when you own commercial property or any property, it's what's called a fee simple basis, meaning that you own the land position and you own the building on top of the land. But there is a structure where you can actually sell the land to one investor and sell what's called the leasehold interest. In other words, the interest in the building that sits on the land to another investor. And the way that works is the ground owner signs a 99-year lease on the building for the leasehold owner. And in exchange, that leasehold owner who owns the building pays the ground owner rent every single year, typically for a 100-year period. These are very, very long-term leases. So from the perspective of the leasehold owner who owns the building, even though, in 99 years, they do have to give the building back to the ground owner, when you think about it, those cash flows that are more than 100 years in the future are worth virtually nothing today on a net present value basis. So for all intents and purposes, when you sign a 99-year lease on a building like this, you effectively own it. You have total control over all decisions. You can lease it to whoever you want, modify the building however you want, collect all the profits from the building. Your only obligation is really to pay the ground rent to the fee owner. And you can kind of think of this structure as an additional form of debt. Essentially the person who's buying the land from you is giving you money in exchange for annual payments for 99 years, right? So effectively it's a form of debt. But we found that this is kind of a workaround to a lot of the limitations that these institutional partners have regarding leverage levels. So these investors could do this transaction, purchase the leasehold interest in the building, and get a 65% leasehold mortgage on top of the proceeds that they got from selling the land to this investor. So when you kind of combine those two things, the sale of the land and the 65% loan on the building, your effective look-through leverage is about 78%. However, most firms kind of meet their maximum 65% threshold on the mortgage itself. So by boosting this leverage to an effective 78%, we could boost our annual yields that the building generated to, between 8 and 10%, which is very, an exceptionally high return for New York City. It's very, very rare that you can buy a, core Class A building, leased to credit tenants in a great location, and make an 8 to 10% return right off the bat. So that was a really unique angle. And that definitely piqued the attention of a few investors, including Samsung, who was the ultimate purchaser in this case. Korean investors love high yields. Oftentimes they will syndicate their investments to high net worth investors all across Korea. Mom and pop investors, they might only be investing 100, 200,000 at a time. And those investors are really just interested in getting their dividend checks every quarter. So they're very attracted to high yield deals. And ultimately, despite all the challenges and the high price, we were able to kind of engineer this above average 8 to 10% return and land an investor and be able to stay in the deal and live another day for at least another 5 years. So once we identified the investor, my role on the acquisitions team, I assisted them in their due diligence process. So when you're doing an institutional deal like this, there's a whole host of analysis and backup research that you have to do, all of which you would learn in a course like this one. That's a lengthy process. We started talking to these guys at the end of May, and we didn't sign up a contract with them until kind of early September. So it was a solid 3 months of really working with these guys, helping them convince their investment committee, providing them with all the ammo that they need to get approval to do the deal. And finally, once they got approval, kind of went through the whole closing process, preparing the closing statement, preparing the wires, collecting the invoices, and all the kind of legal steps that are required to close the transaction. Another element of this class that we would touch on, in addition to the underwriting, the joint venture considerations, and some of the other stuff we talked about in this case. So at a high level, this course is really intended to be kind of a boot camp for all of the work that a typical analyst would do at a real estate firm. And it could be at a wide variety of real estate firms, right? This could be work that you would be doing at an equity firm who's purchasing buildings, or at a debt firm who's providing debt on properties like this. It could be at a service provider like an appraisal firm. So I think all of the skills in this course in terms of underwriting, due diligence, writing investment memos, how closing processes work, what joint venture terms are like, what are typical negotiation points and loan documents. These are practical things that apply to a wide range of real estate firms, not necessarily just equity firms, but real estate's a pretty robust industry with a lot more roles than you might expect.
That's great. Thanks, Alex. So I thought it'd be helpful to hear, I think, a prior colleague of yours, and also who works in a different sort of part of the value chain, David Young. He's on just to kind of hear reactions to this case from the brokerage perspective, and also just more broadly this core skill set that you covered, Alex, as it relates to areas even outside of acquisitions and more broadly across the real estate spectrum.
Sure.
Thanks, David.
Yeah. So great job, Alex. It's good to see you again. I think I'm somebody that I was talking with Matt and Alex this week and just sort of told them my story. We were just catching up, sort of big picture about stuff. And I had mentioned that, in addition to, college students and people that sort of want to learn the sort of technical side of this business, I felt like there was a whole host of people that had reached out to me in the middle of COVID-19, especially because I was formerly a broker at CBRE, and that were like, hey, I'm leaving the brokerage business. Like, I'm out, peace, I'm done with this. And I had gone from being a broker and working on a very sort of dynamic team to then working at L&L. And when I say that I'm somebody that sort of had to learn everything Alex is talking about the hard way, I literally went into this company like, an Excel amateur, and Excel aside, the big picture topics that are being talked about here are the technical elements that I think, one, just make real estate very fascinating. And two, I think, regardless of, I think, what your role is in a real estate organization or what your interests are in developing a career in real estate, I think that in many ways, and I know Alex, somewhat personally, and I know how good he is at this stuff. I think that this is the kind of knowledge that has, for me at least, opened up my optionality significantly. Whether it is going back into brokerage and taking that skill set, or whether it's doing something more in an acquisitions or an investment role or an asset management capacity, something that for me really opened up lots of opportunities. And so when I saw Alex was teaching this class, I thought, it's really worth talking to more people than just, college students and the like, because I think a lot of people almost deal with, and I know a lot of brokers deal with, almost this imposter syndrome sort of mentality of like, I'm not the smartest person in the room because I don't know what Alex knows. Well, I felt like my personal story was I learned all of this the hard way. I wish that there was a sort of 2-week case study, and I'm not even trying to be, very salesy about this. I just felt like a lot of people had reached out to me, and I was pleading with them basically like, hey, don't leave like commercial real estate brokerage where you've invested 10 years of your life to go sell medical devices. Like you can take everything you've learned and have a sort of growth mindset about it, and you can actually go and really improve your skill set as a professional in the industry. And I think that especially commercial brokers, there's a huge need for people to really become more affluent when it comes to the technical side of the business. And so having been a part of the deals, the deal that Alex was just talking about, and being a part of, L&L as a company, and really also just seeing the work that Alex has done, I can't think of somebody who I think would be a better person to be teaching this, not just because the content, if in the hands of the wrong instructor, can be somewhat boring and dull, but also because, I think the boring and dullness of it mixed with, when you really make it something that is practical, like I know Alex knows, he's not an academic sort of by trade. He's somebody who's living and dying and living and sort of breathing this. I think that's what I think would be the biggest value add to anybody taking the class. And so as somebody who, is going to be taking it, and also as somebody who is also had to sort of walk that line of like learning this on the job, and then as I've learned it, really seeing my career sort of open up, it's been something that I think is rare among a lot of brokers, but I think the brokers that do it really, I think, develop really great careers and have a lot more optionality, which I think is always a good thing. So yeah.
That's great, David. Thanks for sharing perspective kind of from the brokerage angle. That's fantastic. And kind of on this topic, one thing we wanted to share with folks on the call who are maybe trying to start careers in commercial real estate and trying to figure out maybe where they would start, and also specifically considering finance or like acquisitions, just to hear from Alex some of the kind of core tips for differentiating and positioning yourself to pursue this field. So Alex, I know you had kind of identified a few key pointers for folks looking to get into this industry.
Yeah, definitely. I would say number one is, learn how to use Argus software. So for those of you who don't know, there's software in the commercial real estate industry called Argus that is used, pretty much universally. Whether you're in acquisitions, asset management, debt, equity, appraisal, everybody needs to know how to use this software. And it is fairly complex, pretty specialized. and there's not really a lot of great resources to learn how to use it, in a practical manner. I took the Argus training workshop that they offer when I was an undergrad student, and it was better than nothing, but I would say I learned more on my first 2 weeks of the job than I did in that Argus class, times 100. So definitely learning how to use Argus software is a huge leg up. Seeing that word on a resume when we're interviewing people is, a big relief, because it is time consuming to train people how to use it. So if you got that out of the way, I think that's definitely a differentiator. Besides that, I know this is kind of a cop out, but I would definitely say, I think it's most important to really show passion for the industry and, just an understanding of the current trends, current news, and just show that it's something you really want to be a part of. There are a lot of technical skills that you need to be an analyst in commercial real estate, whether it's Excel modeling, Argus software, the due diligence work. There is a technical side, but at the end of the day, these entry-level positions aren't exactly rocket science. So I think showing that passion, showing that interest is really going to make a big difference. Really being familiar with the trends going on in the industry, which there's certainly a lot, in the days of COVID, it's causing a lot of changes in a lot of different asset classes. And besides that, I think I've touched a little, but there's just such a wide range of roles that you could go into, as an entry-level candidate in commercial real estate. So like personally, when I started, I actually started on the advisory side at a company called CBRE, where I think David worked as well previously. But I worked on a team that was, selling institutional properties, meaning properties that were valued at $100 million and higher. And that's not even something that I knew was a thing, honestly, as an undergrad. These teams that handle, billion-dollar transaction, $500 million transactions, it's essentially like investment banking, but for real estate. So you're creating pitch books, you're doing valuations, you're talking to all kinds of investors. And that was like the best boot camp I possibly could have asked for, working on a huge range of deals, all different kinds of property types, meeting tons of investors, hearing the kinds of questions that they were asking, just getting that perspective. What are they worried about? What are they thinking about? Was definitely a game changer, but that's just one example. So there's the sell side, there's the buy side, there's debt, there's equity, first mortgage lenders, mezzanine lenders, appraisers, fundraisers, all there's just such a huge industry where all of this kind of financial analysis is applicable, which I didn't really realize, I would say, as an undergrad.
Thanks for sharing some tips and kind of direction, and probably also, hopefully, the sense that there's more than maybe joining an investment banking team in real estate, which is one of the other advisory kind of options.
Sure, REITs,
REITs. There's easily 10 plus tracks that you could pursue if you're trying to go into an analyst role. Mm-hmm. Not to mention the whole brokerage world if you are more sort of sales in relationship kind of focus. So big takeaway is that with some of this learning, it kind of, I think, equips you to pursue more of those options and define which one is the best fit for your interests, getting into the industry. So wanted to give ourselves some time with the audience just to cover Q&A. If there are any questions that folks have about the case, about the course, about Alpha Fellowship, happy to answer the questions now. And we have a little bit of time. So if you do have a question, you can submit it through the, there's a Q&A icon at the bottom. Feel free to share questions there. Any questions in the crowd? I'm going to check the chat here and see if there's anyone who's coming here for questions. I can give another, in case people happen to be typing, let them, okay, I see one here. This is from Robert Friedman. to all panelists, did you use an equity broker to source Samsung? It's a good question.
So the answer is not really. We did have an equity broker that went out and contacted a lot of people, probably 40 to 50 people, but they were not successful. And we've kind of found this. We found that we are better at doing it ourselves in some cases. So Samsung is the investor, an investor that we went to directly. So we did not find them through a broker. But there was a broker that we engaged to kind of help us out. But in this instance, the ultimate investor that did the deal was one we found on our own. It doesn't hurt, to hire someone and check. These people have all sorts of relationships. They have, day-by-day knowledge of who has allocations, who might have, what's called the 1031 exchange, where if you sell a property, you have to buy a new property within a short period of time if you want to avoid paying capital gains taxes. So those are kind of our dream investors, right? Because they have a really tight time frame and they're kind of willing to overpay just to avoid paying taxes. So there's definitely instances where it makes sense to hire a broker. In this case, we did it by ourselves.
Got it. Thanks, Alex. Separate one from Moshe Shalom. Do you have a course syllabus? How do you differentiate yourself from other courses?
Yeah, so if you take a look on the Alpha Fellowship website, there should be a tab called Detailed Curriculum, which covers, a lot of the topics that we'll talk about in the course. But I would say that, 80% of what I'm going to cover is, totally practical knowledge, right? So how to build an Excel model, a dynamic valuation model with sensitivity tables and, all the goodies that investors are going to want to see, how to draft an investment memo, how to perform the due diligence work, how to use Argus is going to be a big part of it. Like I mentioned, it's pretty complex software, especially when you're talking about these, big ticket deals. Investors are extremely careful in auditing these Argus models, and they want to make sure that every single assumption in there is vetted and makes sense. So, probably 30 to 40% of the course will be, related to Argus. But all the details are on the Alpha Fellowship website. And I'd say that, at the beginning of the course, there's probably, 10 to 20% of the course is just going to be background information on real estate finance concepts, real estate economics, just kind of background that you're going to need in order to analyze a real estate deal for those who did not, maybe take undergrad real estate courses. But besides that, primarily stuff that, is not generally going to be taught in a college course.
Great. And then also, Alex, I think one thing worth noting is the Alpha Practicum, which is the 4-week group project that essentially allows students to get some real world experience with some of these concepts and companies that are actually doing this work. So that exists. Certainly in other learning experiences, it's not common, and it's pretty explicitly built in partnership with companies that are almost all investment funds. So companies that are actually transacting in real estate.
Yep.
The other, so there's a question, how long was the recap process and how many investors considered the asset?
So it was a very long process. Our partner first notified us in February, actually January of 2019 that they wanted to exit. And then there was, a long discussion about how that was going to happen and what fashion, under what terms. So we really started, thinking about it and talking to people probably in January, and we didn't end up signing the contract until September and closing until November. So from start to finish, solid 11 months. This was a tough one to get done, at this valuation. So we were very happy with the outcome. And I think I mentioned we had 95 total investors that we spoke to.
Yeah, so long process. That's probably not typical.
Yeah. Typically, we might go out to 10 to 15 investors, not 100.
Yeah, you earned it that time.
Yeah.
Another question related to the LP Samsung. So how long do you think Samsung will hold this asset? And we'll start with that. And there's a two-part question. So how long do you think they'll hold the asset?
Yeah, so they, I mentioned that these Korean funds often will syndicate, most or all of the equity to high net or to individual investors across Korea, and because of that, they typically have a 5-year maximum holding period, and that's just because individual investors might not really be comfortable making a commitment for more than a 5-year period, and so that's kind of the max for them. So they'll likely sell after 5 years. And I see the second part of that question. You describe how the money partner gets dividends over time. How does the GP make their income? So we own, I think 5% of the deal in this new recap. So Samsung put in 95% of the money. We put in 5%. So we definitely get our 5% share of the profits that the building generates every month. But on top of that, we provide a lot of services to the building. So we make money as a firm with property management fees, with leasing commissions. We own our own cleaning company. So the company that cleans all the tenant spaces, we make a profit there. We own a security company who mans the desk. So we make a profit there. We own an art leasing company that rents artwork to display in the lobby, and we make money there. So that's, the beauty of these commercial real estate operating companies is that we get to put in 2 to 5% of the money and really leverage that with all those fees that we make, and it's a pretty nice business to be in.
A question I had, I definitely just included in the all panelists and attendees, so probably can see it there, but how's the COVID environment impacting deal flow, valuations, and overall career opportunities in commercial real estate?
Yeah, that's a great question. I think part of the answer is that it's just a little too soon to really know. The part that makes it hard to do deals right now is that nobody really knows what rents are. Some tenants who had leases that just happened to be expiring this year, are doing renewals. And there are, a few instances of big new leases like Facebook taking 700,000 square feet in Hudson Yards over the summer. But generally speaking, leasing volume has plummeted and people don't really know what rents are yet. They don't know how much rents have really fallen because there's been so few deals. And when you don't know what rents are, it makes it very hard to value a building. And so, sellers basically are taking the position that values have not fallen whatsoever. Buyers are saying they're only interested if values have fallen 20 to 30%. So we're just kind of going through this extended period where kind of not much is really happening, except for distressed situations. So if you had a property where your loan was now coming due and you had to refinance it, that could be an issue. Or maybe you're a private equity fund and your fund has already been out for 5 years and you've got to return your money to investors, so you have to sell. Or maybe you're on a ground lease and now you're running into trouble because some of your tenants aren't paying rent and you can't cover your ground rent. So those kind of messy distress situations are definitely starting to pop up, and those are the majority of deals getting done right now. But high level, people aren't really voluntarily selling unless they don't have to for now. That said, I think once leasing volume picks up a little bit, we're definitely seeing a handful of buildings hit the market in New York just over the past couple weeks. Big transactions, anywhere from 300 million up to almost $2 billion, and these are voluntary sellers. So that's a good sign for the market. In terms of career impact, not too much, I don't think, on the investment side. A lot of firms are raising new capital. A lot of investors are interested in taking advantage of this distress that's emerging. If there is an expectation that property values are going to fall, 10, 20, 30%, a lot of investors are interested in capitalizing that. So a lot of people are raising money, hiring investment professionals. Certainly if you were working in the subsection of the industry that focused on retail or focused on hotels, that would be a little bit more problematic. But broadly speaking, fundraising is very healthy in the investment business for commercial properties. So it's still fairly good.
That's great. Any other questions? I think I saw another one come through. in the fee bifurcation example, you spoke of lease rights and land rights. Are sky rights usually a consideration in New York City properties that aren't landmark designated?
So I assume they mean, what's called zoning square feet or floor area. So that's essentially development rights, additional density you may be able to develop on a site. And when you have a bifurcated estate where you have one person owning the land and one person owning the building, almost always the leasehold owner, the person who owns the building, would also own any air rights that were there. So if they ever wanted to develop more in the future, that would be their option. Development rights typically would travel with the leasehold or the building interest.
Got it. Any other questions from folks on the call? Thanks for sharing some good follow-ups here. And Alex, thanks for offering a lot more detail and context around 195 and then some of the industry trends and career trends. If anyone else has a question, feel free to share it now. We have a couple more minutes. Otherwise, I can just offer a couple closing remarks. And one here was, any good newsletters to subscribe to keep up on the industry? Yeah, what are some things you read and follow?
Yeah, a great one is called BizNow, BISNOW. They send a morning email every day with like the 15 top stories, both locally and nationally. So that's a good one. Specific to New York and some other major markets like Miami, Los Angeles, there's a website called The Real Deal, which I definitely read every single day. And besides BizNow and The Real Deal, I'd say the two other biggest ones are Cranes and Commercial Observer. And they cover things nationally, but both of them are based in New York, so definitely a focus on New York overall.
Super. Thanks for sharing those, folks. So just a couple closing thoughts here. For those folks who are interested in anything that we're doing within the real estate acquisitions course, feel free to send us an email. So the email that we use is admissions@alphafellowship.com. We're also going to be hosting more of these workshops in different topics over the coming months. So if you follow our LinkedIn page, we announce those workshops there. So we have one coming up on Wednesday in product management. We'll have another one coming up soon in applied finance. Really great instructors. Again, folks who do this, in the field and have done for typically close to 10 years minimum. So they're pretty experienced in their respective fields. But thanks for joining us. Really appreciate everyone hopping on the call here and sharing time. And Alex, thanks again for walking us through the case study, which you probably know like the back of your hand now.
Yeah, of course. Yeah, we'll talk. I think I'll probably use this transaction, as an example throughout the course, in a lot more detail. Tried not to get too technical, but lots more to the story.
Yeah, I think it's great. I enjoyed it. And David, thanks for sharing your perspective as well. It's great to have you on the call.
Yeah, absolutely. And I saw Patrick just asked if the slides could be shared. I wanted to make sure you saw that as well.
Oh, great. Thanks. Yeah, so I think what we'll do, thanks for asking that, Patrick. I think we can share probably a condensed version of these so we can make that available as well. Absolutely. Any other questions from folks? Otherwise, we'll give you a few minutes back here and really appreciate everyone here joining us. Have a great evening.
Bye, guys.
Thanks, Matt. Thanks, Alex.
Take care.
See ya.
Take care, Alex. Take care, Dave.